Hello everyone, I am Mr. Navaran Mandal and you are watching my channel THINKONOMICS-Study with Navaran. In our last lesson, we have discussed about the commercial bank and the different functions of commercial bank. We have studied about how the commercial bank accept deposit in the form of saving deposit, in the form of time deposit, in the form of recurring deposit, and also the current account deposit. We have also studied how the commercial bank give loans to the businessman or to the investors in the form of term loan, in the form of outright loan, in the form of overdraft facilities. My dear boys and girls, we have also studied about the discounting bill of exchange. Now, some of you have given a good comments that discounting bill of exchange has been explained in a proper way. Thank you very much. More you watch, more you give the positive comments. It always motivates me to teach you in this platform so that it can be helpful for to as many students and as many friends of mine. So, my dear boys and girls and my friends, today I will be discussing the central bank and the function of the central bank of India. We have studied that in a country, in each and every country, there is one apex bank which controls the function of all other bank in our country. In case of India, the Reserve Bank of India is the central bank. Suppose, for example, Bank of England is a central bank of the country United Kingdom. Federal Reserve Board is a central bank of the United States. Like this, different countries have the different central bank who look after the day-to-day functioning of the commercial bank. They lay down the rules and regulations for the commercial bank, and they definitely do the transaction with the government. Now the question may arise in your mind, why central bank? Why we need a central bank? My dear boys and girls, we know that the commercial banks, the main motive is to maximize profit. So, if there is no central bank and the power of issuing the currency notes, or the supply of money is given in the hand of the commercial bank, they will manipulate it in order to maximize their own profit. They will not take into consideration about the national interest. Suppose, for example, during the time of inflation, what we need is to reduce the supply of money. But if it is given in the hand of the commercial bank, they may not do that. They may increase the supply of money in order to increase their profit. That's why we need the central bank whose main motive is the national interest, not profit maximization as it is for the commercial bank. Now in your board, one of the important questions is what are the functions of the Reserve Bank of India, or what are the functions of the central bank? The main functions of the central banks are issue of currency note, acting as a banker to the government, acting as a banker to the bank, credit control policy, and number 4, stabilizing the value of money in the country. In case of India, let us first discuss The function of the Reserve Bank of India with respect to issue of currency notes. In case of India, whenever the Reserve Bank of India wants to print the new money, they have to keep a certain portion of the gold reserve and a certain portion of the foreign exchange reserve, on the basis of which the Reserve Bank of India can print the new money. Here also we have to remember that the Reserve Bank of India, they prints the money of the denomination of rupees 2 and above. The question that I said it to you, how much of the gold reserve and how much of the foreign exchange reserve, it has initially, it was changing, it has been changed. Now the fixed amount of gold reserve and the foreign exchange reserve has to be kept, so that the Reserve Bank of India can print the new currency notes. We have already discussed that why Reserve Bank of India, why not the commercial bank? Because the main motive of the commercial bank is to maximize profit, so they will not print the new currency note or issue the new currency note according to the national interest. They will do it for their own profit maximization motive. Hence it has been given to the Reserve Bank of India. Question may also be there in your mind that why not it has been given to the government of India. The issue of currency note has not been given to the government of India because the monetary policy may not be stabilized. The government changes, and the policy of the government, with a change in the position, change in the chair in the central government, will differ. For example, the monetary policy, if a communist party is there in the central government, or if, will be different than that of the monetary policy of the NDA government, which is there in the central government. So if there is a change of chair, the monetary policy will also change and the supply of money will change. That is why it has not been given to the government, central government. Again, there will be political, if it is given to the government, there will be political pressure on the government to change the policy, which may not be beneficial for the country, but will be beneficial for the political party to come into power. So in order to safeguard the interest, the national interest, the issue of currency notes has been given to the central bank of our country, that is the Reserve Bank of India. I hope this is clear. The very first question, that why the issue of currency notes has not been given to the government or to the commercial bank, and why it has been given to the Reserve Bank of India. So we have found the answer. The second function of the Reserve Bank of India is that it acts as a banker to the bank. Just as we public deals with the commercial bank by keeping our savings over there and taking loan from the commercial bank, Reserve Bank of India do the same with the government. Whatever income of the central government or the state government, it is getting deposited in the Reserve Bank of India, and whatever expenditure will be incurred in the future, everything will be taken place from the account of the government, which is maintained in the Reserve Bank of India. So it is said that the Reserve Bank of India is a banker to the government. When the central government wants to sell the bond, in order to pump out the money from the economy, It is not possible for the government to come and sell it to the commercial bank or to sell it to the people. So this selling of the bonds will be done by the Reserve Bank of India. The government bonds are sold by the Reserve Bank of India. And the money which is collected by selling of the bond, by selling of the government bond, will also be deposited in the Reserve Bank of India. So this purchase and sale of the government bonds, that is the open market operation, is taken care of by the Reserve Bank of India. This is the second function of the Reserve Bank of India or the central bank. The third function of the Reserve Bank of India or the central bank is that central bank or the Reserve Bank of India, it acts as a banker to the bank. Commercial bank, when they need money, when they want to take loan, and they are not in the position to take it from any other sources, where they will approach? They will approach to the Reserve Bank of India. That is why the Reserve Bank of India is known as the lender of last resort, because when the commercial bank is not getting loan from any other source, the only source which is left for them is the Reserve Bank of India. That is why the Reserve Bank of India is called the lender of last resort. Actually, here the commercial bank will have to deposit the securities to the Reserve Bank of India in order to get the loan, which is called the rediscounting bill of exchange. In our last video, we have discussed about the discounting bill of exchange, that the commercial bank is giving back the money to the individual after 60 days. Now, the commercial bank has to wait for another 30 days to get that money back from the reserve, to get the money back from the consumer. All right. Now, if the commercial bank has to get the money within that 30 days, maybe after 75 days, then from where the commercial bank will get that money? Commercial bank will have to take that bill which the customer has deposited to the commercial bank. They will take this bill to the Reserve Bank of India and get a certain amount of money after the Reserve Bank of India rediscount the bill of exchange. This we have to keep it in mind. But the most important function of the commercial bank is the controller of credit or the controller of the supply of money in the economy. Reserve Bank of India increases or decreases the supply of money according to the need of the country. There are two ways by which the Reserve Bank of India controls credit in our country. One is called the quantitative credit control policy, and the other one is called the qualitative credit control policy. My dear boys and girls, this is important not only for the board exam, that is for the ICSE, ISC or the CBSE, even if this is important for your common admission test and also for any type of competitive exam. How Reserve Bank of India increases or decreases the supply of money in the economy in order to control the inflation and deflation. There are two ways, as I said it to you: quantitative and qualitative. Now, under the quantitative credit control, there are four instruments to control the credit. The four instruments of the quantitative credit control policy are bank rate, open market operation, cash reserve ratio, and statutory liquidity ratio. So what is bank rate? What is bank rate? Bank rate is the rate of interest which the central bank charges to the commercial bank when the commercial bank asks for loan to the Central Bank of India. Actually, this is the cost of borrowing money from the central bank by the commercial bank. That is how much interest the commercial bank will pay in order to get the loan from the central bank. This is called the bank rate. Now let us see that how the change in the bank rate, how the Reserve Bank of India by changing the bank rate will increase and decrease the supply of money in the economy. Suppose, for example, that in the economy, inflation is going on, all right? And we know that if there is an inflation, what will happen? It will bring hardship to the people, purchasing power will go down, okay? So the welfare level of the people will go down. So the government cannot keep the inflation, okay, going on and on. So the government will have to reduce the inflation in order to safeguard the interest of the people. There are two ways by which the government can do. One is the fiscal policy, the other one is the monetary policy. And we are dealing with the monetary policy. So the way by which the Reserve Bank of India will control the supply of money through the bank rate is by increasing or decreasing the bank rate. During the time of inflation, the Reserve Bank of India will charge higher rate of interest to the commercial bank. So the loan now became costlier to the commercial bank. What the commercial bank will do? Commercial bank in turn will charge higher rate of interest to the investors who wants to take loan from the commercial bank. All right. So loan is now much more costly, much more expensive even for the investors. Now, as the loan became much more costlier, investors will take less amount of loan. Hence, less investment in the economy, less employment generation, less income opportunities, which in turn will curtail the demand of the individual. So demand will be less. And if the demand falls, we know what will happen in that case. The price of the goods and commodities will also come down to a stable level, and thus inflation will be controlled. My boys, I'm repeating it once more. During the time of inflation, the Reserve Bank of India will increase the bank rate, so the loan became much more costlier to the commercial bank. The commercial bank in turn will charge higher rate of interest to the investors. So investors will take less amount of loan, and as the investors are taking less amount of loan, what will happen in that case? There will be less investment in the economy, less employment generation, less income opportunities. Hence the demand will be curtailed, and thus the inflation rate will be controlled. This is how the Reserve Bank of India will control the inflation in the economy. Just in the opposite way, during the time of recession, what the Reserve Bank of India will do? During the time of recession, the Reserve Bank of India will decrease the bank rate. As the Reserve Bank of India decreases the bank rate, what will happen in that case? Now the loan became much more, it becomes much more easier to get, you can say. It becomes much more cheaper, you can say. So the commercial bank will take much more loan from the Reserve Bank of India. Investors will take more loan from the commercial bank because now the loan became much more cheaper. So the supply of money in the economy will increase. And as the supply of money in the economy increases, there will be more investment in the economy, more employment generation, more income opportunities, demand will increase, and thus the price will move in the upward direction. to a stable level, and the recession will be controlled. This policy is called as a cheap money policy, while the previous policy is known as the dear money policy. So sometimes in the competitive exam, they can give it to you, what do you mean by the dear money policy, whereas sometimes they can give it to you, what do you mean by the cheap money policy. So the dear money policy means the money is becoming dearer because the Reserve Bank of India is increasing the bank rate. All right. Whereas the cheap money policy, it becomes the money is becoming cheaper. That is, the Reserve Bank of India is decreasing the rate of interest which they are charging to the commercial bank, and thus the same process will follow. So, my dear boys and girls, this is the way by which the Reserve Bank of India can control the supply of money in the economy, and thus control the inflation and deflation in the economy through the bank rate. The second way by which the Reserve Bank of India can control the credit in the economy is through the open market operation. What is open market operation? Open market operation is actually, it is the purchasing and the selling of the government bonds. And who purchases and sells the government bonds? It is a Reserve Bank of India. Reserve Bank of India purchases and sells the government bond. When the people will purchase the government bonds, what will happen? They will withdraw the money from the commercial bank. If I have to purchase a bond, if I have to purchase the government bond, okay, I do not have so much money in my pocket, okay, or in my home. I generally keep my money in the bank, in the commercial bank, suppose say State Bank of India. So if I want to purchase, suppose 100 government bonds, okay, so in that case, what I will do, I'll go to the State Bank of India, I will withdraw my money, and then I will purchase the bank, or I will instruct the State Bank of India, please purchase these 100 government bonds in my account. So now the amount of money which I used to have in the State Bank of India will be reduced. In the same way, if the number of people wants to buy more and more of the government banks, what will happen? They will have to withdraw the money from the commercial bank. So now the commercial bank will have the less amount of loanable fund. They will have a less amount of loanable fund, because why? Because we are withdrawing the money in order to purchase the government bond. Suppose 100 rupees. Suppose all the consumers in India have deposited 100 rupees in the commercial bank, and all of us has decided that we will buy the bond, okay, government bond, because it is giving the high rate of interest. So we have decided to purchase the government bonds, and thus we have withdrawn. All of us together has withdrawn rupees 30 in order to purchase the government bond. So how much money will be left with the commercial bank now to give loan to the investors? It will be 70, because 100 was there, 100 we have deposited, but we have withdrawn how much? Rupees 30 in order to purchase the government bond. So the amount of loanable fund with the commercial bank has decreased. Now, as the amount of loanable fund with the commercial bank has decreased, which implies that there will be less investment in the economy. Because initially, how much money was there with the commercial bank? Rupees 100 to give loan to the investors. Now, as we have withdrawn the money in order to purchase the government bonds, the amount of money left has decreased. So there will be less investment in the economy, less employment generation, less income opportunities, and thus the demand of the good will go down, and it will control the inflation. So, my dear boys and girls, what the government will do what the Reserve Bank of India will do during the time of inflation? During the time of inflation, the Reserve Bank of India will sell the government bonds to the public and also to the commercial bank in order to take out the extra amount of money which is there in the economy. This extra amount of money has to be taken out in order to control the excess demand in the economy. So, this open market operation, by the open market operation, we have learned how it will control the inflation in the economy. Just in the reverse way, if there is a recession in the economy, some of the economists are saying that India is entering in the phase of recession. So what will be the government steps in order to control the recession? One of the steps to control the recession in the country is to buy back the bond. Is to buy back. The government will ask the Reserve Bank of India, you start purchasing the bonds from the people and from the commercial bank. So as the Reserve Bank of India will start purchasing the bonds from the people, all right, or from the commercial bank, now the money supply will be in the opposite direction. That is, the money supply is will start flowing from the Reserve Bank of India to the commercial bank, and from the commercial bank it is coming to the people, to the hand of the people. So the supply of money in the economy has increased. And as the supply of money in the economy has increased, now the purchasing power of the people will increase. People will be able to purchase more and more amount of good. So the aggregate demand in the economy will increase. And if the aggregate demand increases more than that of the supply, what will happen? The price will move in the upward direction until and unless it reaches to a stable level. So this is a way by which the government can control recession by the open market operation. So my dear boys and girls, I hope you have understood these two functions of the actually this is the third function of the Reserve Bank of India, and this is a second quantitative instrument to control the credit supply in the economy, and this is the instrument to control the inflation and deflation in the economy. There are two other instruments also to control the money supply in the economy under the quantitative credit control policy. Third one is called the cash reserve ratio. The third instrument of quantitative credit control is the cash reserve ratio. Every commercial bank has to keep a certain portion of their demand deposit with the Reserve Bank of India. All right? The percentage varies. The percentage can vary from 3% to 15% according to the Banking Regulation Act. Let me make it more easy. Suppose the commercial bank, they have received a deposit of rupees 100. All right, they have received a deposit of rupees 100. Now, will the commercial bank keep the full amount of money with them? The answer is no. According to the Banking Regulation Act, out of these rupees 100, the commercial bank had to keep a certain portion of the money with the Reserve Bank of India. Now, if the economy is normal, means there is no inflation in the economy, there is no deflation in the economy, then in that case, the Reserve Bank of India asks the commercial bank that you have to keep 3% of your total demand deposit, okay, and the time deposit with the Reserve Bank of India. So out of rupees 100, how much the commercial bank is keeping with the Reserve Bank of India? It is rupees 3. So how much money will be available with the commercial bank now to give loan? It is 100 minus of 3, that is 97. This is the loanable fund, we can say, which is available. Now suppose there is an inflation in the economy, so the supply of money in the economy has to be controlled, as we have explained just few minutes back. So what the Reserve Bank of India will do now? Reserve Bank of India will now ask the commercial bank that you have to keep 10% of your demand deposit and time deposit with the Reserve Bank of India. So how much money will be kept by the commercial bank to RBI? It is rupees 10. How much money will be available with the commercial bank to give loan to the investors or to the businessman? It is just rupees 90. That is 100 minus 10, that is rupees 90. So see the difference. In the first case, when the economy is in a normal condition, RBI is asking the commercial bank, you just keep rupees 3. So 97 is available with the commercial bank to give loan to the investors. Whereas in case of if the country is having the inflation, in that case the RBI has increased the CRR, so the amount of money which is left with the commercial bank to give loan is only rupees 90. That is, it has been reduced. The supply of money has been reduced in case of inflation by increasing the cash reserve ratio. So during the time of inflation, the RBI will ask the commercial bank to increase the cash reserve ratio. All right, CRR will be increased. So less amount of money will be available with the commercial bank to give loan to the investors or to the businessman. Hence, the investment will be less. Then the employment will be less. Income opportunity will be less. Demand will be controlled, and the price, the average aggregate price, will also come down to a stable level, and thus the inflation will be controlled. Whereas during the time of deflation, in order to control the deflation or the recession in the economy, what the RBI will do? RBI will now decrease the cash reserve ratio. As the RBI decreases the cash reserve ratio, the amount of loanable funds with the commercial bank will increase. So the amount of investment in the economy will also increase. So as the investment increases, we know the process that through the increase in employment, through the increase in income, all right, what will happen? The demand of the people will increase, and thus the price will move in the upward direction until and unless it reaches a stable level. So my dear boys and girls, this is the third instrument. This is the third instrument uh, which is used by the RBI in order to control the credit in the country during the time of inflation and deflation. Now, the fourth instrument of the quantitative credit control policy to control inflation and deflation is called the statutory liquidity ratio. Statutory liquidity ratio. Only commercial bank other than the cash reserve ratio has to keep a certain portion of the cash, gold reserve, and the other securities with the Reserve Bank of India. Please keep it in mind. Here, the RBI, the commercial bank, they are keeping a certain portion of their cash, gold, and the other securities with whom? With the Reserve Bank of India. And this percentage must be at least 25%. At least 25%. It can be increased. So statutory liquidity ratio is actually the summation of the value of cash plus gold plus the other securities divided by the demand and the time deposit. This is statutory liquidity ratio. And this is as I said it to you, it is minimum of 25%. It can go to 30%, 35%. So what Reserve Bank of India do is that during the time of inflation, just like the cash reserve ratio, Reserve Bank of India will increase the statutory liquidity ratio in order to control the demand. Whereas during the time of deflation or the recession, the Reserve Bank of India will decrease the statutory liquidity ratio in order to control the deflation. So my dear boys and girls, so these are the four instruments of the quantitative credit control policy to control the inflation and the deflation in the economy, or to control the money supply in the economy. What are the four instruments we have discussed? The first one is bank rate. The second one is open market operation. The third one is a cash reserve ratio, and the fourth one is the statutory liquidity ratio. So these are the four instruments. Now there are, as I said it too, other than quantitative credit control policy, also we have the qualitative credit control policy, which are also used by the Reserve Bank of India in order to control the supply of money in the economy. And there are other functions of the Reserve Bank of India also, like stabilization of the value of money. All right. So all these things we will learn. We'll learn in our next video. We'll learn in our next video. By that time, I hope you will go through the video. And as you are watching the video, I will always ask you to go through the textbook also. It will be helpful. First of all, if you hear it from me, then it will be much more easier. And after that, if you read the textbook at least once, I hope you will get the good result from this. So thank you very much for watching my channel THINKONOMICS-Study with Navran. Now, I just want to say that now already half of the year is over. Another 5-6 months left for your board exam. By this time, at least you should have finished 5-6 chapters in your school, and you must start solving the previous year's question paper. You will take out the questions from the previous year's question paper which you have already studied, and you must start writing. You must start practicing, especially the diagrams, where if you know the diagram, if you mark it properly, it will be very, very easy for you to score. All right, once more, thank you very much. Stay safe. All right, Jai Hind and Namaskar from Nabrun.